everyone. Hope you're doing well. In case you have forgotten who I am or you have not even seen me before, this is Ed Dolatabadi. I'm a realtor broker with Royal LePage Signature. And today I have invited Sean Humphries from Dominion Lending Leading Edge. Is that correct?
Dominion Lending Center's Edge Financial.
Edge Financial, to have some share thoughts about mortgage, because in real estate we might think that real estate is the most important thing, but without the right mortgage we won't be able to do anything in real estate. So no further ado, let's just welcome Sean and just have a conversation about mortgage.
Sounds great.
Yeah,
thanks a lot for having me, Ed.
My pleasure. Thanks for accepting my invitation.
How could I say no?
You could just say, open your mouth and say no. Thank you. So, do you want to tell us about what's happening with the mortgage right now in this environment that we have? And there's lots of talks about it. Mortgage overnight lending rates went up, all of those things. So bring us up to date.
Depending on when somebody's listening to this, mortgage rates, I've never felt so popular before. Like, there's a lot of discussion in the mainstream media when it comes to mortgage rates. They're talking about the overnight lending rate, and they're talking about fixed rates and variable rates and all these different rates. The underlying theme, though, is they're all going up, right? All of the rates are going up.
Everything is going up.
And so what that means for investors or real estate people looking to purchase in real estate is it's going to cost you more on your mortgage.
Oh, good news.
Yeah, that's good news.
Wow.
But, there's lots of ways to save money. There's lots of ways to make sure that you've got the right mortgage, not just for the rate going in, but how that might cost you money throughout the life of the mortgage.
Right.
And so setting up and having those conversations, both your real estate agent and what your overall goals are, and then setting up your mortgage to make sure that it's reaching those goals is very important before you just go out and start driving around and going to open houses.
Exactly.
Yeah.
That is a very good point. I totally understand and get that and experience that. Like, without a clear understanding of what you can qualify for, what you can get, going out and looking at homes is just sometimes disappointing, because when you cannot qualify for this home, and you have seen the homes that are at such a high price, and now you tell them you can only qualify for 20% less than this.
Right.
Then the homes that you see, I don't like them.
Well, exactly. And finding out, you can only qualify for $400,000 is not going to get you very much in the city of Toronto. So it's not like you cannot purchase, because you can, but you can't borrow as much money as you'd like.
Yeah.
And, sometimes that's a shift in the dream of what it will be like to buy the next property. And sometimes it's, okay, what are the solutions to help you be able to borrow more?
Right.
A lot of first-time home buyers are going through that exact activity right now, right?
Exactly, yeah.
Do they need a bigger down payment? Do they need, I was joking with one of my clients yesterday, and over the course of about 6 months to a year that I've been talking to her, she's received 4 raises. Wow. And she keeps getting just a little bit more. And I'm like, well,
nice.
In order to qualify for this property, you're going to have to go and get another raise. And I said it kind of as a joke, but that's or you get somebody to co-sign with you, or you save a bigger down payment. There's some different things that they can do in order to get there. And it would be similar for our investor type clients as well.
Right. Yeah. Another thing that I have seen, it's not as popular or as common as the ones that are qualifying for less than what they expect, is the people who are qualifying for more than what they think that they would qualify.
Those are the best, aren't they?
They are, but they're just talking to them and say, well, we can't afford this. It's like, how come? Because this is my situation. I said, well, why don't you come and talk to Sean? And he might look at the different avenues that you might not have, because people usually nowadays, everybody goes to our good friend Google and search and look at how much I can qualify for.
Right.
And the things that they are not aware of is all the details of a professional Like the details that a professional knows, they don't. They only look at the numbers and all those. So I have had at least 2 cases in the last 6 months that the people, professionals, they thought that they could not afford to buy a home and they need to rent still. And we just worked at their situation, and they are qualifying and they bought.
Well, and I think that's a good example of not knowing exactly what you're looking at when you go and do those Google searches and when you're using some of those online calculators and realizing, oh, I can only qualify for this much. Well, that's true at a very specific lender, but there might be other lenders that might help them to borrow more, right? And a lot of times, or the opposite, where, I've just started my job and I'm getting promised a guaranteed bonus of 15% or 20%, and they include that number in their income. You know as well as I do, that's not income we can use right away. We need to see a 2-year average of that bonus income.
Right.
And so that often will mess people up a little bit, right? But I mean, that's where you find good professionals and good guidance to help you get into the right situation, and you're not spinning your wheels and going to look at properties that you don't qualify for. Even like, the daily activity of going on, your real estate apps and looking at all the properties and dreaming about that next property, right?
Yeah, speaking of that, I have going on. People are going, like, nowadays there are so many apps that they provide data for public, and it's great to have data.
Yeah.
But sometimes the data without an understanding of the market, it could be actually doing not serving you at all, because when you get the data, it's great. But now how are you going to analyze the data depends on your knowledge of the market.
Right, sure.
Like, I have clients that they say, well, it's such and such and such, we're sold for this price, so this one should sell for this price. I said, no.
Yeah.
No, not really, because you don't consider that why did these sold for that price, or in some cases, maybe a few weeks ago in our freehold market, like something that was sold for $900,000, but something similar to that on the same street would have sold for next week would sell for $950. You can't say that. So these are the things that it is crucial to have a professional like yourself.
Do you find that people, like, I find that the people that get caught up in that, oh, this should sell for 900, like, they're very data driven. You're like your engineers, your accountants, like, they start analyzing that data on their own without some of the, the art of knowing this property is going to go for more because of A, B, and C, or maybe it'll go for a little less because the market is softened, or because this property doesn't show well, it doesn't have good pictures, for example.
Yeah, exactly. Right? Yeah, like I absolutely agree with you. And to my wonderful engineers, accountants, professionals that are taking like 90% of my clients, so I would say we all love you, but sometimes you become, if I tell you, if you're my client, I tell you, you do your engineering job, let me do my real estate job.
That's right.
Or let Sean do his mortgage job, because that's where a professional comes in, and with the information. Just give you an example. If you look at the stats of right now, we don't have the stats of March, the sales price.
Right.
If you look at the stats of February and want to go in the market and buy with the February stats, you don't have the March stats yet. How are you going to perform? It's already like we are on the road. We are, like, you and I are experiencing the mortgage, real estate prices, and everything daily.
Right.
We can smell it. We can feel it.
Yeah, touching and feeling it every single day.
It's not like the stats. The stats is good for the economists.
Right. I would think it's similar to like somebody who's a junior engineer or a junior, accountant. They know all the rules. They don't necessarily know everything about it, right?
How to use those. Yeah. Perfect.
Yeah.
Thank you. So let's talk about what I hear a lot is that, like, during the price increases the last couple of years, people have unwantedly or like they haven't worked on this, but they a value of their properties have gone up, and people are thinking of refinancing, taking money out. And I always tell them, if you're taking the money out, make sure you put it in the right place. You don't take money out for spending, but it's your money. You can do it whatever you like. But yeah, tell us about like refinancing and how does it work. And obviously, for me, as someone who is in real estate, I would say if you're taking money out of your home, it's a good choice to invest it in another home because you can appreciate how much your home value has appreciated. So tell us about that.
Yeah, I mean, I think we've all seen it. If you're a homeowner and you've just been so lucky just to hold a home for
10 years.
10 years more, you've got a ton of equity in your property. And a lot of people, probably heard the term refinancing or taking equity out, but what does that really mean, right? Like it sounds wonderful, right?
Yeah.
And I get a lot of questions like, what happens with the money when I refinance, right? Honestly, the money goes to you. That money, however much you take out, goes to your bank account. Now it can go directly to your bank account, or it can go to another property or another investment that you make. And sometimes that's the easiest thing is to take the money out and either use it for a deposit on maybe pre-construction, or use it for a deposit or a down payment on another property. The tricky thing about it is, though, we have to qualify you based on how much debt total you can borrow. It's not like one property I can borrow $1 million and on the next property I can borrow $1 million, and it is a total amount.
Right.
And then dividing it up based on, okay, maybe we can make it a little bit better with some rental income on the next property. Or using some of our lenders, like our credit unions, for example, that don't need to use the stress test, helping us to borrow a little bit more money than maybe you might with some of our big banks, for example.
Correct.
So the idea of refinancing is it's essentially just going through a mortgage application, doing the credit. Let's check your income. Let's look at your other debt commitments as well. And sometimes that's the tricky part as well. They've already, yes, you would like to purchase something and there is equity, but maybe you already have a mortgage on your property that's taking up the majority of what you can afford to borrow. So there isn't room to necessarily pull out. Yes, you can pull up to 80% of the property. You can have a mortgage up to 80% of the property value on a refinance. But sometimes you only qualify for 50%, right?
Correct.
You can't pull out any more money because you don't have the income to qualify for that.
Correct. Yeah. Those are the things that's really important for people to be aware of, and it's something that you need to come again to a professional that can help you with that. It's
That's
just
right.
like not just, it's good to have ideas. Then as soon as you have the ideas, you want to come and see how close it is to the reality.
Right. I mean, it's amazing to have those dreams, right? Like you have to have that idea of this is what I want to do, and then bring those ideas and those dreams to your real estate agent, to your mortgage broker, and then have them help you figure out, okay, well, here's how we're going to do it.
Exactly.
And I think that sometimes the leap for people is that they think of it as their mortgage on their principal residence. They don't think about it as necessarily a business. Right?
Right.
They think about, okay, I'm going to borrow this money. I want to get the lowest rate. I want to get the most money. Those things are all important, but how are you setting yourself up for success in this new business investment that you're making, right? Is it maybe a mortgage that is going to be shorter term because you're going to want to turn around and flip it in a few years? Or is it you're not as worried about paying off the mortgage because you know that you're gaining equity from the property?
Right.
So talking through some of those ideas and not just, well, I want to put 5% down on this purchase, right? It just doesn't work that way. You have to have a minimum of 20% down for any investment property. I think a lot of people lose sight of it's going to require a significant down payment as well.
So like these things that people have, people come, like they go to some of these online webinars or seminars or whatever, and they tell them that you can, you can buy like whatever 50 homes in a year or
Right.
this and that. What do you say about that?
I'd love for you to tell me how. Like, I'm not seeing those, people being able to buy that many properties unless they're partnering with other people that either have income or they have down payment to do it. Can you get on title on all those properties? Yeah, probably, but you're not doing that alone. That's a group effort, to say the least.
At least for some, like a city like GTA.
For sure.
If you're like in like some suburbs of United States,
I think
you
that's
might have the chance to buy property
Right.
for whatever. I don't know the market. I don't want to be giving any price, but they are not as pricey
Right.
as here, and the returns might be okay. But for here, when people come and say, "Well, I have like 3 properties and I want to add one more to it," it's great. But like we have to sit down and talk and see how is your
Yeah.
situation, how's your finances. Another thing that is that are you willing to like pay for a higher rate mortgage?
Mm-hmm.
If you're thinking, "Oh, yeah, the rates are really great, let's just invest on another property," that's good. But if you don't qualify for this great rate, would you be willing for paying
Right.
a higher rate? Is that
Well,
correct?
and in thinking about it as a business in that
Right.
case, right? So maybe it's going to cost a little bit more on the rate. Maybe it's going to cost a little bit more on a down payment, or sometimes there's a fee to get into some of these mortgages that allow you to borrow a little bit more. And if you're looking at it as an overall investment and here's the maximum amount of money that you're going to be able to borrow, that might make sense because overall you're going to make a profit from the business.
I see. Yeah. Okay. Perfect. So now we talked about this, the taking the money out of the equity out of their home and investing in another property, either being a pre-construction or a resale.
Right.
Which ones do you would you suggest? What is like? What do you think in terms of the financing? It would help people with less.
Yeah, I always like it when somebody's going to purchase their next principal residence. So they're going to rent out the existing, maybe they live in a condo and they want to move to home. I think that's always an interesting situation to work on. You're familiar with the property, you know what you have, you know what it would rent out for, and then you're buying something that's going to be a right size for your family going forward, right? Maybe you've outgrown this condo, you want to figure out either how can we move into another one? Maybe we don't have a down payment to go towards it, or B, maybe we have some down payment. We just need to supplement that with some more mortgage. And you can take that from your existing principal residence, turn that residence into a rental property, and in the same motion, buy your new principal residence.
Okay.
But there's lots of ways to do it, right? Like there's maybe it's a cottage and you want to buy a second property for a cottage. Airbnb rental is really hard to use on a mortgage qualification. It's not something, because that's a business.
Right.
We would have to have, in order to use the rental income, it needs to be continuous, long-term, proven income.
Yeah.
Or not even necessarily proven, just it can't be just short-term Airbnb rental income.
Okay. Perfect. Another subject that I wanted to talk about is these, like nowadays there are like the one of the highest grown sectors of the freeholds in last few months was the properties over $2 million. How does the mortgage for those work? Can you give us an idea of, let's say,
Sure.
Because like people with a high income, like good couple are working and they have good income, what do they need to know about the down payment, how much they can get the mortgage for it, and all of those, because this is becoming one of the more...
Sure. Yeah. $2 million is the new $1 million purchase,
Exactly.
right? Like there's so many properties out there that are...
$2 million is nothing.
$2 million is... Well, exactly. Like $2 million is the new $1 million, right? Like it's you can have some average-looking properties in the right neighborhoods that $2 million is getting your foot in the door,
Well,
right?
there are semis that are sold. Like I saw a semi that was sold for 3.15
Really?
in Riverdale, and
That's
and
where
it
I
was
live.
like I can guarantee that I can find at least 100 homes very similar shape. There was nothing unique. It was
Right.
not like a specific property. It was a
It was the
semi in
neighborhood, maybe a
Riverdale.
school
Yeah,
zone.
exactly. But 3.15 for a semi. So it shows like over 2 million is something that is becoming a norm
Right.
in our city, and we want to be more. Are there any talks about increasing that $1 million, like the
Oh, for
level,
the
for the CMHC for the mortgage insurance?
right. So if you have just
Can we
to
go
back
like
up,
sorry?
yeah,
Can we go back and say like explain like
yeah,
what are the
I think it's a good idea.
yeah
So when you have purchased something over $1 million, you need to have 20% down.
correct
Okay. So if you've got less than 20% down, you can purchase with, for less than $1 million purchase price, you can purchase with less than a 20% down payment. So it's 5% of the first $500,000 of the purchase price, and then 10% of the balance. So just to give you like an example, at $999,000, your minimum down payment is $74,900. Add $1,000 more to the purchase price at $1 million, your minimum down payment is $200,000, like $125,000 more of a down payment in order to purchase over $1 million.
Right.
Now, regardless of the purchase price, if it's a rental property, you need 20% down. Okay,
Doesn't matter.
Yeah, it doesn't matter. Has to have 20% down.
Thanks for clarifying that, because that's something that majority of public don't know.
Right.
People come to me and say, well, I have a very good income. I want to buy something for $1 million and I want to do it with 5%. I said, okay, hold on.
Yeah. Wait. Let's back it up a little bit
Yeah,
here.
exactly.
Yeah.
So that's very good. Thank you for clarifying.
Yeah. And if you have less than 20% down on any purchase, you're going to have what's called mortgage default insurance, kind of popularly known as CMHC or the Canada Mortgage and Housing Corporation, their default insurance. And so that is something that gets added on to the mortgage amount. It's not something you pay out of pocket. It gets added to your mortgage. So if your mortgage is $700, mortgage default insurance is $715. Your total mortgage that you'll pay off over the
25
term,
years.
it would be $715,000. You were asking about $2 million.
Let's go
now.
to
Okay,
$2
so
million.
$2 million. So if you've got a $2 million purchase, the minimum down payment with some lenders is 20% down. But not all lenders. Some lenders will require, they have what's called a sliding scale. So they will say that we need 20%, just to use an example, 20% of the first million, and then we will lend 50% of the balance. So they need $200,000 for that first million, and then they would need $500,000 to go up to $2 million. That's a very extreme example, and it's something that's going away, but just to give you an example. So the higher you go, the more likely, like if you went to 2.5 million, it's very likely that a lender would say, we'll give you 20% of the first 2 million, but we're going to need 50% of the next 500,000. So it's not always just 20% down. Some of the things that will come into play would be credit, your income, the source of the down payment can also, it's just the overall profile of the borrower would be.
So it's case to case being studied. And,
Yeah, the higher you go,
right.
If you're one of your professionals, more likely to get some exceptions like that.
Got it. Okay. Perfect. That was great. That was very good information. And lastly, even though we talked about this, but again, like I'm not saying like an exaggerated case, like let's say like 50 properties to have as investment property. But if people are it's their goal, their what do you call it, long-term goal to see, they see themselves that they are buying multiple properties.
Right.
And if they're doing it their first and the second one after their principal one, what are the suggestions? What do you think that people need to do to build a kind of portfolio that is like to be prepared for doing that? I mean, there are things that they might be able to do or at least be aware of while they are having this kind of plan for the future, So if I'm buying something right now, I have the money to put down and you can afford to do it, blah, blah, blah. And then next year I'm planning to buy another one.
Yeah.
Do you have any suggestions for these type of clients?
Well, I think the larger your initial down payment, the easier those subsequent purchases are going to be. You know, if you want to lower your debt commitments as much as you can in comparison to your income. I was read this morning, and I'm sure I'm going to butcher it, but one of the things that I was reading this morning was that in terms of Canada's housing price versus the rent that you would get from it is the biggest gap that it's been in history.
So true.
Right? So you can't just rely on rental income. Oh, I'm going to get $2,000 a month or $3,000 a month from rental income. You need to have some other income in order to qualify that, in order to qualify for more money. One of the other things that I see that people get tripped up on is like having other debt commitments outside of properties. So they've got credit card debt or lines of credit. The other one is car, right? Like, you know, everybody loves to drive these fancy cars and look around, look good driving, right? Exactly. The thing is, could be the difference between another property, right? If you've got $1,000 per month on your, you know, as a debt commitment to a car, that's going to reduce the amount that you can borrow. Yeah, exactly. So drive an old car, Ed.
Get your motorcycle out.
Exactly. I mean, moped, right?
So we chatted shortly about this, about the rumors going on, like that there are going to be some limitations on. We
were talking about this earlier, right?
So you want to touch on that?
Well, it's a rumor.
I don't want to spread the rumor, but we are.
Rumor, exactly. So one of the things that we've been hearing is that they're going to start, because we have a supply issue, right? So there's just not enough supply in the GTA for the number of people that are here currently, and the 450,000 people that are currently slated to come into Canada every year for the next 3 years. So we can't keep up with those people. And I just want to set the table as that's where it's coming from. And so one of the things that they're looking at, rumored to be looking at, is that the minimum down payment is going to be 35% on for investment properties. That's up from 20%. Now, if you might say to me, well, I'm already telling my clients that they should have 30, if not 35% down, just in terms of being able to cover the properties and the rental income, being able to be cash flow positive. That's a great rule of thumb, but you can purchase right now with 20% down. So what they're trying to do is take away some of that investor demand, maybe some of the pre-construction properties, and have those more readily available for first-time home buyers. So that's a rumor. The other rumor is that they won't be able to borrow money from it won't be able to be borrowed money in order to purchase another property. So
it has to be.
If you've got $300,000 or whatever just sitting in cash and ready to do it, you won't be affected. But if you're looking to take money out of your property, which is something that we've been talking about,
right?
That's possible that source of the down payment would not be allowed.
Right.
So you would have to either have the money, take the money out in a mortgage and have it sit there for a period of time, and that would be one way to do it.
Be able to be okay to pay for the payments as well without having it invested in anything.
Yeah, exactly. Or you would have to have your own money, or sometimes it's inheritances, or rob a bank is always an option. Anyway, these are just rumors, of course, but just as for your audience, I thought it'd be important to share some of the. Shh! Don't tell anybody.
Awesome. Okay. Is there any advices do you have for my clients or your future clients?
I'd say it's the looking at your debt commitments that you have right now. If you can reduce some of your credit card, lines of credit, car payments, that's going to help put you in a better position to be able to afford more property.
Perfect. And checking your what's it called, the credit report at least once a year and make sure that there's nothing nothing unusual on it.
That
right?
happens too, right?
Yeah.
So every so often we're telling somebody, this looks weird. You should go call Equifax and see,
And then
see
good
if they can
luck
sort
calling
it out.
Equifax.
Yeah, exactly.
If you're one of my clients, I know one of my clients is the Equifax staff. I mean, like they are hired by Equifax. I'm nothing against you, but if you're Equifax, good luck being able to call Equifax. It's like,
So I thought you were going to say, and don't forget to follow me on Instagram. That was the other.
yeah,
Yeah, that's
okay.
the other. That's
So follow
my
him
other
on-
tip.
Yeah, you can follow him on Instagram. You can follow me on Instagram. And if you're, looking at watching this on YouTube, feel free to subscribe and share with your friends and family. This is it was a pleasure being with you. Thank you so much. Thanks again for accepting my invitation.
Absolutely, it was a pleasure.
And yeah, looking forward to working together.
Sounds good. See you next
soon.
time.
Okay. Lastly, I wanted to mention that I'm planning to do these videos once a month. Don't hesitate to tell me. Send me a message. Let me know what topics, what subjects you'd like to hear about real estate, mortgage, financing, anything like anything real estate related or not real estate related, as long as I can do it. If you want to do something on horses, I can do. Or other hobbies that I might have. So just send me a message. Let me know what you'd like to hear. And thank you again.